Two self-employed investors in San Antonio, Texas, own a short-term rental that has been performing well on Airbnb. They did a cash-out refinance. They pulled out over $75,000 from the property. They locked in a lower interest rate than what they had before, and they positioned the deal for both more cash flow and significant tax advantages. This is exactly what the strategy looks like. Let's break it all down. What is going on, guys? Welcome back to another deal of the week. If you are new here, my name is Ricardo Carrillo. I run RC Lending Advisors. We're a nationwide mortgage lending company that helps clients all across the entire US, plus Puerto Rico, get financing for both residential and commercial deals. Whether you're buying your first home or scaling your real estate portfolio, my team and I will walk you through the entire process with all of the connections needed from A to Z. The whole point of these videos is to show you real deals with real numbers about real clients and exactly how they're structuring their deals so that you can understand what is possible when you go to do this the right way. Now, this deal that we did was a cash out refinance for a client on an investment property that they had in San Antonio, Texas. It's a short-term rental being operated on Airbnb, and there's really two main things that I want to walk you through on this deal. The cash flow play and the tax strategy behind this, because for these two clients, both of those things mattered. Let's jump into the numbers first. This property is a single family home in San Antonio, 1,700 square feet, 3-bedroom, 2-bathroom house, and it appraised for $330,000. Now, we ended up doing a conventional investment property loan on this. It was a $264,000 loan amount with no PMI because we had more than 20% in equity already. We actually locked in a lower interest rate than what our client had before at a 6.875. It was on a 30-year fixed rate. And to be able to get a rate below 7% on an investment property is pretty crazy in this market. Most investment property rates have actually been running higher than primary residences, typically 0.5% to a percentage point more, because lenders price in for additional risk. A rate below 7% in this environment is honestly just the best kind of possible solution. The principal and interest on this loan came out to be $1,734 a month. Homeowners insurance was at $416 a month, and property taxes at $540 a month. The total monthly payment on this, that puts us right around $2,700. It was at $2,691. Now, San Antonio has actually been one of the most, if not more, active markets in the country that I've seen for short-term rentals. It's a city that has strong year-round tourism. It has a proximity to military bases for people who need to go there, consistent flow of visitors that keeps short-term rental demand stable really across multiple seasons. And a well-managed 3-bedroom property in the right part of San Antonio could very easily generate income that is well above $2,600 a month, which is the monthly payment on this house. And that's kind of the whole point of the cash flow play. You want to be able to make more in revenue than your current mortgage payment. And the idea behind a short-term rental is that you're going to make even more than what you would from a long-term rental. Because the refinance paid off the existing loan that our client had of $160,000, after all of the closing costs and everything else was covered, our clients actually walked away with a little bit over $75,000. It was real capital that was able to be reinvested into the next deal. They could use it to, fund re-improvements on their existing house, or really just utilize it for whatever you wanted to. It's kind of equity that was already sitting in the property, and it wasn't doing anything. And it didn't even increase the monthly payment all that much from what we had before, because of the fact that our client had a higher interest rate. The piece that I really wanted to get into, though, was talking about taxes, because it's the part that matters for people who are high income, they're self-employed borrowers. It's something that a lot of people tend to overlook. And ultimately, I'm not a CPA, but I do work very closely with a lot of CPAs who specialize in real estate. And I've pretty much seen firsthand how the right property and the right structure can significantly reduce what a high income earner and a high income investor owes in taxes every single year. That's why many of my high income earning clients tend to purchase real estate from a tax advantage standpoint, not just a cash flow standpoint. For anybody who's self-employed, you're generally going to be generating more income than you would through W-2. And so because of the business, owning short-term rentals specifically it can create an opportunity for more tax deductions for you. Ultimately, when you own a short-term rental that you actively manage, the IRS could allow for you to take more depreciation deductions against that property. And in some cases, you can even use the losses to offset income from your business or other sources. Now, the standard depreciation on a residential property is over 27 and a half years. However, with a cost segregation study, you could actually break the property down into its individual components. Think of things like flooring, appliances, fixture, HVAC, even landscaping, and you can depreciate those items over a much shorter timeline. Instead of 27 and a half years, sometimes 5 to 7 years. And when you combine that with bonus depreciation, which allows you to front load a large portion of that accelerated depreciation into the first year that you own the property, the tax deduction that you can create here is like substantial. I mean, I've seen hundreds of thousands of dollars that clients have written off in depreciation and pretty much paid nothing in taxes. So for two high income earning self-employed clients like these, a deduction like that in the first year or even the second year could offset a significant portion of their business income and dramatically reduce what their tax liability would have even been for that year. Now, I always tell my clients that in situations like this, obviously you want to work very closely with your real estate CPA before doing anything like this. I have CPAs that I personally trust and refer clients to regularly if that's something that you guys need. But the right tax strategy around a deal like this is worth more than the actual deal itself. The combination of cash flow from the short-term rental, equity access through the refinance, and even tax reductions through depreciation is exactly what sophisticated investors are looking for when they're wanting to build a portfolio that works on multiple levels, not just on things like cash flow only or equity pay down only. If you're wanting to understand what a refinance like this would look like for your situation, or if you want to get connected with a CPA who truly understands how to use real estate for you, or how to even create a tax strategy that might look like for you, go to rclending.co. You can find me on Instagram as well at Richie the Lender. I appreciate you guys for watching. If you've stuck around this long, make sure that you like and subscribe the video. And if you haven't seen my other Deal of the Week videos, you can check them out either here or here. But I will see you guys in the next Deal of the Week.